Hello and welcome to another episode of the Smart Finance Hub. Today, we're talking about a topic that might sound scary, but actually has great potential: the smart use of debt to grow your wealth. You might be thinking, debt? Shouldn't we avoid that? Well, get ready, because we're about to change your perspective. In finance, debt can be more than just a burden. It can be a powerful tool. We're going on a journey into the world of clever financial moves, where debt becomes a useful tool. Our first secret to building wealth from debt involves one of the most lucrative and time-tested strategies: investing in real estate. Real estate can be a powerful wealth-building asset, and debt can be the key to unlocking its potential. Investing in real estate using debt can be a game-changing strategy on the path to wealth creation. One powerful concept at the core of this strategy is leverage, the ability to use borrowed capital to increase the potential return on investment. Imagine you want to purchase a $200,000 property and you have $40,000 in savings. Instead of using only your own funds, you leverage debt to cover the remaining $160,000. If the property value appreciates, your return is calculated on the total $200,000 investment, not just your initial $40,000. Mortgage strategies play a pivotal role in real estate debt investment. Choosing the right mortgage type, be it fixed rate or adjustable rate, can influence your cash flow and risk tolerance. For instance, a fixed-rate mortgage provides stability in interest payments, while unadjustable rate mortgage may offer lower initial rates but carries the risk of fluctuations. Now let's explore the dynamic between rental income and mortgage payments. Say your mortgage payment is $1,000 per month, but you're generating $1,500 in rental income. That positive cash flow not only covers your mortgage but provides additional income. This positive arbitrage showcases the potential of using debt to invest in real estate, as the property essentially pays for itself while appreciating in value over time. In the realm of real estate investment, leveraging debt strategically can amplify returns and accelerate wealth accumulation. Now that we've discussed using debt for real estate, it's crucial to understand the concept of good debt versus bad debt. Not all debts are created equal, and making the right choices can significantly impact your financial journey. Good debt and bad debt are dichotomies that define the financial impact of borrowing. Good debt is an investment that has the potential to grow in value or generate income over time. For example, taking a mortgage to buy a home can be considered good debt, as the property typically appreciates, providing a long-term return on investment. Similarly, student loans for education are often viewed as good debt, as they can enhance earning potential in the future. Conversely, bad debt refers to borrowing for non-appreciating or depreciating assets or consumables, which do not contribute to long-term wealth. Examples include high-interest credit card debt used for discretionary spending or loans for luxury items that quickly lose value. Good debt generates wealth by facilitating investments that outpace the cost of borrowing, whether through increased earning potential, asset appreciation, or income generation, can lead to financial growth. On the other hand, the pitfalls of bad debt lie in the interest paid without the potential for wealth accumulation. High interest rates and the absence of a tangible return can trap individuals in a cycle of debt, hindering financial progress. Distinguishing between good and bad debt is crucial for making informed financial decisions and building sustainable wealth. Businesses often require capital for expansion, and debt can be a valuable source in fueling growth. Whether you're a seasoned entrepreneur or aspiring to start your own venture, understanding how to use debt for business expansion is vital. Utilizing debt for business expansion can be a strategic move, propelling growth and increasing profitability. Scaling your business with debt involves borrowing capital to invest in projects, acquisitions, or operations that will enhance overall performance. For example, securing a business loan to expand production facilities or entering new markets can lead to increased revenue and market share. Calculating debt capacity is essential to ensure that the borrowed funds can be repaid comfortably. This involves evaluating the business's ability to service the debt through cash flow, profitability projections, and risk assessment. It's a delicate balance, taking on enough debt to fuel growth without overburdening the business. Successful business stories often highlight entrepreneurs who judiciously use debt for expansion. For instance, a tech startup securing venture debt to invest in research and development, leading to groundbreaking innovations. Similarly, a retail business leveraging debt for strategic acquisitions, expanding its product line and customer base. However, it's crucial to approach business debt cautiously, understanding the risk, and having a clear plan for repayment. When used wisely, debt for business expansion can be a catalyst for success, driving increased revenue, market presence, and long-term sustainability. Investing in yourself is perhaps the most valuable investment you can make. From education to skill development, debt can be a means to enhance your personal and professional capabilities. Let's delve into the ways you can use debt to invest in yourself. Harnessing debt to invest in yourself is a powerful strategy for personal and professional development. Education financing is a prime example, where taking out loans to fund higher education can lead to enhanced skills, expanded knowledge, and increased earning potential. For instance, obtaining a student loan to pursue a specialized degree can be an investment in future career opportunities and financial success. Skill development and training are another avenue for using debt to enhance your capabilities. Taking out a loan to enroll in a professional certification program or workshop can sharpen your skills, making you more competitive in your field. This strategic investment can open doors to higher-paying roles or entrepreneurial ventures. Balancing short-term costs with long-term gains is crucial when using debt for personal development. While taking on debt incurs immediate financial obligations, the long-term benefits, such as increased earning potential, improved job prospects, or entrepreneurial success, can outweigh the initial cost. For example, investing in a coding boot camp might involve short-term financial sacrifices, but can lead to a lucrative career in the tech industry with substantial long-term gains. Ultimately, using debt to invest in yourself requires careful consideration of the potential returns and a commitment to maximizing the value gained from the investment in education, skills, and training. No financial strategy is without risk, and using debt is no exception. In this segment, we'll explore the potential risk associated with debt and how to navigate them intelligently. Risks are inherent when using debt as a financial tool, and understanding these risks is crucial for informed decision-making. One significant risk is interest rate fluctuations. If interest rates rise, the cost of servicing debt increases, potentially impacting profitability and financial stability. For example, a business with variable rate loans may experience higher interest expenses, affecting its bottom line. Market fluctuations represent another risk associated with debt. Economic downturns can lead to reduced revenue, making it challenging to meet debt obligations. Real estate investments, for instance, may be adversely affected by market downturns, potentially leading to property devaluation and difficulties in meeting mortgage payments. Over-leveraging is a risk when debt exceeds a borrower's capacity to repay. While leveraging can amplify returns, excessive debt can lead to financial distress. For instance, a company taking on too much debt to fund expansion may struggle to meet repayment obligations if anticipated growth doesn't materialize. Effective debt management is crucial in mitigating these risks. Establishing a clear repayment plan, diversifying debt sources, and regularly reassessing financial positions can enhance resilience. For example, a homeowner managing mortgage debt might offer a fixed-rate mortgage to mitigate interest rate risk or refinance during favorable market conditions. In summary, the risk associated with debt, including interest rate fluctuations, market dynamics, and over-leveraging, underscore the importance of prudent financial management and strategic planning when utilizing debt for wealth-building activities. And there you have it, the keys to mastering the art of building wealth from debt. Remember, it's not about avoiding debt, but leveraging it intelligently to unlock doors to financial prosperity. If you enjoyed this journey into the world of smart finance, don't forget to hit that subscribe button, ring the notification bell, and join our community of savvy wealth builders. Thank you for being part of our community. If you have any questions or topics you'd like us to explore in future episodes, drop them in the comments below. Until next time, stay financially savvy, keep mastering the art of wealth building, and I'll catch you in the next episode right here on the Smart Finance Hub. Take care.